In this video, I'm going to talk about the concepts of risk and rate of returns. So, these chapters we will define and we will discuss about the risk and returns fundamentals and how to calculate the returns and how to calculate the risk relating to an investment. So, first of all, we will define the return. Return is the total gain or loss that is experienced on an investment over a given period of time. That can be calculated by dividing the asset's cash distribution during the period plus any change in the value by its beginning of the period investment plan. You can understand it more clearly when I will give it them the some numerical value. Whereas the risk is a measure of the uncertainty surrounding the returns that an investment will earn, or more formally, the variability of returns associated with a given asset. So, returns of a security or of its asset is the change in the price. So what does mean by the change in price? Means the price today minus the price some previous period of time plus any cash flow that we received divided by the beginning value. We can calculate the returns over many horizons. Means we can calculate the dollar returns, we can calculate the percentage returns. Dollar returns simply mean the change in the value. For example, the initial investment at the zero time, this is the timeline, this is the zero time. Have put an amount of $100 by purchasing the stocks of a company, and its value after 1 year changes to $120. So the change value is 20. 20 is the dollar returns plus it dividend is received of an amount of $5. So 20, that will be another cash flow that has been received over the investment horizon. So any change in the value plus any amount of other cash flow that has been received is the dollar return. And when we divide this dollar return over the beginning investment, then we will get the percentage return. So this is the dollar returns. When it is divided by the beginning market value, then it gives us the percentage returns. So a dividend plus change in the market value, change in the market value mean price today minus price some previous period. This is the change in market value. And dividend divided by the beginning investment is the dividend yield, whereas change in the market value of the asset divided by the beginning investment is the capital gain yield. When we are going to describe the historical prices of the stocks in the stock market, and these are described in terms of average returns. So these are one where returns in the year in the period one, return in the period two, then it's going on. And these returns values will be definitely calculated by using these formulas. So the average returns would be the returns over many number of years, number of periods divided by the total number of periods. That will be the average returns, and the historical capital market returns are described in terms of the average returns. Whereas the expected return is used to look at or find out the future expected returns. So based on our average returns that are the historical returns average values, what we can expect for our investment in the future. So expected returns is the expectations that we are expecting from our investments based on our some historical returns. So these expected returns are calculated by these are based on the probability distribution values, and these are the weighted average of the probability distribution of the possible return. What does it mean? What does it mean? That the expected returns are the probability for the period one multiplied with the expectations, not expectation, returns for the first any returns that are attached with that probabilities, and then we will sum up all these probabilities with their related returns. And these are the weighted average of the probability distribution of the possible returns. So we can do it by doing an example on the Excel sheet. So these are the given values. The expected returns of star K returns are given the following distribution values. So demand for the products for the company's product is, if there is a 10% probability that the demand would be weak, so the rate of returns can be minus 50%. If there is a chances of loss if the demand is weak, and there are chances of 10% for such situation. Below average, there are 20% chances that the demand would fall below the average, and we can have a loss of minus 5%. Average, on average, there would be the demand chances of demand increase would be 40%, and then we can get an average return of 16%. Above average demand has the probability of 20%, that would have the return of 25%. And their strong demand of the company products have the probability of 10%, and that is going to expect a rate of return of 60%. So what is our expected return? Expected return for the rate of returns of this based on the demand of the project. So the expected return can be found out by multiplying a probability with this average returns. So to find the value of the expected return, first of all, we will multiply all these values. 10% multiplied with this minus 50. Minus 50%. So just multiply this probability with the related rate of return. So for the next column, 20% probability has been multiplied with minus 5%. For the next is 0.4 would be multiplied with 0.16. Last one, 0.1 multiplied with 0.6. So we will just multiply the probability with the rate of returns, and having the sum of these weighted returns will give us the expected returns. So I am just going to solve it by putting equal sign, that converted into a formula. expected return we can write it in percentage 11%. So there is an expectations of having 11% rate of returns according to the demand of the project, company's project. So this is how we can calculate the rate of returns, and based of the rate of returns we can calculate the expected returns, and then on the basis of the expected returns we can expect that what can be our future returns for the specific project. So in the next video we will talk about the risk of the investment. Thank you so much.